Welcome to the Invest with Clarity podcast, where you will learn how success in investing, as in life, is the result of absolute clarity. Mark Pearson of Nepsis in Minneapolis, Minnesota, shares his passion for portfolio management and commitment to transparency and communication to allow investors to fully understand what they own and why, bringing them to clarity in their investments. And now, here are your co-hosts, Matt Halloran and Mark Pearson.
Hello and welcome to another Invest with Clarity podcast with Mark Pearson. Today, we're going to talk about another one of the proprietary processes that they use at Nepsis to truly help you understand what you own and why you own it. And it's referred to as a stress test. Now, there are many stress tests out there, but very few are equal to what we're going to talk about today. So, Mark, welcome to the show.
Thanks. Always good to be with you, Biggie.
So let's talk about stress tests. Number one, why don't you philosophically explain to our listening audience what it is, and then let's talk about what makes it different.
Sure. Well, stress test is exactly what it is, says it is. It's a test to designed to help investors understand where there could be potential stresses in their portfolio that could inhibit them from accomplishing their investment and planning goals. You know, you think about the bank stress tests after the financial crisis. If you look at our stress test, what's really designed to give investors a better understanding of truly what is under the hood in their portfolio. And of course, every single one of these that we've done, the people, their eyeballs, pop out of their head about 5 feet.
How do you do this? What do you put through the stress test? Give us an example.
Yep. So let's start back from the beginning. I think it's important to start back from the beginning. As you mentioned in the beginning of the podcast, it's everything we do here at Nepsis is about process. And for those who have followed our podcast over the time that we've been doing these, I was going to say over the years, over the time we've been doing this, people know that we believe that successful investing is this idea about having the ability when needed or desired to know what you own and why you own it, because it enables you to have greater clarity and understanding in making the decisions you need to make to accomplish your financial and planning goals. Okay. So when we sit down with a new prospective client, new prospective investor, we take them through two very simple questionnaires. The investment stress test questionnaire is a 6-question questionnaire. It takes literally about 3 minutes to fill it out. And the other questionnaire we have them fill out is what's called the Clarity Compass. It's about 8 to 10 minutes of a questionnaire that gives a very quick snapshot to the investor where they lie within the 6 financial planning categories. And even if we're not going to do the Clarity Roadmap, which of course is our proprietary financial planning process, i.e. Investment and planning journey, we believe that your investments are the fuel that enable you to accomplish the investment goals. And so when we work with a client, we won't work with them unless we're managing the assets, because we want to control the quality of the fuel and the management of those fuel tanks to accomplish those goals. So the stress test questionnaire is pretty simple and straightforward. Do you currently work with an advisor? Does your spouse have other investments? What's been your experience with your current advisor? What would you hope to gain from taking our stress test? Your age range? Do you have an investment policy statement in place? By the way, I've never had a yes on that one, Matt, as we've discussed many times before. And what is the investment objective of your current portfolio? What we do then is we take their statements from their brokerage accounts, their 401ks, whatever it is that they have, and we plug all of that data into Morningstar. So for those who don't know, Morningstar, unbiased, all it is a database of information on positions held within mutual funds and ETFs by different companies. The system then runs a report and tells us the top 500 holdings in the portfolio and tells us the breakdown from an asset allocation strategy, how the portfolio is structured. We then put together all that information into the stress test, and we provide the investor with hard evidence of potential pitfalls that could inhibit them from accomplishing their financial goals.
That was a lot of stuff there, dude.
Well, yeah, it's process, right?
Well, yeah.
But even though it was a lot, it doesn't take that long to do. That's the shocking thing about it.
Okay, so let's talk about outcomes.
There's a lot of information there.
Do you mind if we kind of talk about outcomes and how you put all of that information into something that's palatable for the client?
Yes. Yep. So what happens is, literally, with all that stuff I just told you, the investor literally ends up getting a 3-page document that shows nothing, and it's actually very simple to read. It's broken down by how many positions are in the portfolio, what the 3 largest positions are in the portfolio, and the breakdown between U.S., non-U.S., bonds, cash, etc. The second page lists out the pros and cons of the portfolio and a commentary on things to look out for and what can happen in the portfolio. The third page is just disclosures. That's it. So it's a fairly straightforward, very easy to understand document. In fact, Matt, the document is created in a manner for people like me who think more visually, which I believe most people do. I think most people make decisions based on things they see than things they hear. Because if you see it, you believe it, right? If you hear it, you don't necessarily believe it. So when you see it, and it's fun to see their eyeballs pop out about 5 feet, as I talked to you about before we started the podcast, if people are amazed. They're absolutely amazed at how their money is managed. The fact is, most people don't have a stinking clue how their money is managed, period. Mm-hmm. They just know they own a bunch of funds and ETFs, and someone behind the green curtain's making decisions.
That green curtain is a thick curtain, too, because they don't have the clarity that you're talking about here. Okay, so what are the next steps in the process here? So they've answered the question. The report is delivered. You go over the report with people. Then
yes. So the financial advisor goes over the report. So here's an example of one that of a person who became a client. And by the way, I should tell you, if people are interested in taking the stress test, they should go to investwithclarity.com and click on the stress test link there. There's actually a quick questionnaire on there. And from there, you get reached out by a financial advisor to help do the stress test, or you can just click on the Let's Talk and we can get the stress test done for you. We do it at no charge, but the portfolio has to be a minimum of $150,000. So just because there's a cost involved on our side, even though it doesn't cost the investor anything. So we do the stress test, right? And in this particular case, this person owns 2,439 positions. I should tell you it's a $750,000 portfolio to give you a perspective, Matt, of the size of the portfolio. Of that $750,000, and this is what the investor is seeing in a very straightforward, easy to read report, they own 820 stocks and 1,619 bonds. Their 3 largest holdings are Microsoft at 2.72% of the portfolio, Nextra Energy at 2.13%, and the Home Depot at 1.82% of the total portfolio. By the way, just so you know, to give you perspective, the top 10 holdings in this portfolio make up a paltry 16% of this total portfolio. So then what we do is we break it down. Those are their largest positions. And oh, by the way, we're recording this right now in November of 18. Emerging markets are down 17% year to date. International's down 10 or 11. You have in international as a whole, even you're seeing a breakdown in the U.S. markets because the FANG stocks are finally breaking down. It's not been a very good year in terms of returns in the United States, even relative to the rest of the world right now. Don't you think you'd want to know why your portfolio is not getting the returns? Where are the pitfalls that are inhibiting you from making money? That's what this tells you, right? So in this particular case, this investor, we went back and we showed them the 500 positions in their portfolio, the top 500 positions. And I think I told you when you got to about position 300 in this portfolio, it basically hardly registered anything in the portfolio. Actually, at position 500 in this portfolio, remember, there's 820 positions. So that means there's another 320 positions in this portfolio that equate to $5.29 or less of the total portfolio. Let me say the number again. $5.29 from position 500 all the way to position 820. At about position 300, give or take, okay, it starts registering zero in terms of percent of the portfolio on the Morningstar report, and that is $36.72. So in other words, you're talking about over roughly 500 or so positions in this portfolio make up $36 or less of the total portfolio. Now, to me, that's staggering. And you have to ask the rudimentary, commonsensical, fundamental question: is that really investing? I have you speechless.
I'm baffled. That seems like that doesn't even make sense to me. Why would they have those bottom 500 holdings? I mean, what is the justification? Okay, so that's the question. What is the justification that you have heard from other financial services professionals about positions like that?
Sure. It's simple. Most financial advisors, I don't want to put everybody in that category, but most financial advisors are not money managers, they're wealth managers. And the reality of it is that the financial advisor does not have the time, and in many cases does not have the skill set to really do the deep dive analysis of a portfolio. And so what they do is what the industry has taught them to do, which is they get sales pitches from different fund companies and different investment ideas, and they go with it. And if you remember, I think we talked about on one of our previous podcasts, the whole concept of modern portfolio theory. Most investors don't even know what that is, but it's basically the idea of asset allocating your portfolio from large, mid, and small cap stocks, growth, value, international, emerging markets, bonds, real estate, all the way down the line, right? And so financial advisors, in an effort to asset allocate the client's portfolio, they end up owning, I've seen situations where people own 30 mutual funds in their portfolio. And in each of these mutual funds own hundreds, if not thousands of stocks in their portfolio. This particular stress test, the client owned 9 mutual funds, okay, and then some stocks. There's not a strategy here. It's really a function of just putting everything out there, and for lack of a better phrase, they call it closet indexing. This, hence, Matt, is the fundamental reason why I believe that many investors have gone to the idea of benchmarking and getting their investments as quote-unquote cheap as possible, because in the absence of value, thus becomes cost. And if all you're doing is putting me in boxes, and all you're doing is kind of, cookie cuttering my portfolio, which a lot of these people are doing, where's the value proposition? And when markets go through what they're doing right now, where's the value proposition? Wait till you by the way, I got another stress test in front of me. You ready for this one, Biggie?
I don't know. I'm still reeling from the last one, man. But yes, please.
That was only 820 positions.
Oh, no. Okay. Yes, please give us another example. That would be fantastic.
8,372. Now, usually we see between 2,000 and 6,000 positions, 6,000 companies and portfolios. 820 is actually on the lower side of it. I've seen them as low as 450. And of course, here at Nepsis at investwithclarity.com, it's we usually own between 20 to 40 companies while still asset allocating the portfolio, right? 8,372 positions. Again, is that investing? And by the way, here's the interesting thing on that one, Matt, because I have you speechless today. I'm just going to run with you here. The largest position is 18.58% in Walt Disney, because lo and behold, the person worked at Walt Disney. So they have 18.5% of their portfolio in one stock, Walt Disney, great blue chip company, while they still own 8,371 other companies in this portfolio.
18% 8% in one company.
Right. Now they work there.
Okay.
And I'm not going to say right or wrong, good or bad. That's up to the individual investor, because frankly, one of the beauties of investing with clarity is the investor has the opportunity and ability to control what they own, right, and why they own it. And so this person worked there. I believe they have a tax strategy to bring it down some. But at the end of the day, the ability to understand, because people who listen to this podcast may have stock options, right? They may have stock that they had when they worked at a company. They may have legacy stock in their portfolio. And right or wrong, good or bad, I'm not saying you sell it or not sell it, but understanding where your assets are and how they impact the overall plan is frankly the most important piece of the deal. And when you got 18.5% of your money in one stock and the next stock position is 1.59%, it's a bit of a discrepancy, right? And the person's going to dwindle it down. But in this particular case, by the time you got to position 500 on this portfolio, he was at and by the way, this was a $238,000 portfolio. So this is a smaller one than the last one. It was at 0.03% at 500, which was $64.12, which means that 500 positions, 8,300 stocks, about 7,750 stocks, give or take, are $64.12 or less. No wonder people are going for the cheapest thing they can get.
Well, and it's no wonder that this is a nebulous pit of despair that most people just throw their hands up in the air and say, this is all just too complicated. There's no possible way I can understand, all of these different things.
Bingo. And so they have to try to trust the process, right? Now, why does this become excruciatingly important? Well, when you're in periods, look, no great quality portfolio manager has a great year every year. As a matter of fact, statistically, and for those of you who are tuning into the podcast, this is the most important stat I'm going to give you today. The highest performing alpha managers, the guys like Warren Buffett's of the world, studies show that they underperform their stated benchmark almost 50% of the time, yet still provide the highest level of alpha in the marketplace, and they underperform 50% of the time. Warren Buffett historically has underperformed about 33% of the time on a year-over-year basis, right? So this is why investors are in a quagmire, and this is the whole basis of the foundation of investing with clarity at investwithclarity.com. It's not as important to know what you own and why you own it as it is important to understand that you have the ability to know what you own and why you own it. Because what most investors are doing is they're moving from one fund to another. They're moving from one financial advisor to another. They're moving from one fund class to another, doing this and doing that. And the fact of the matter is, Matt, bottom line, the only basis for the decision that is made to move from one investment to another is either I don't like the advisor or I don't like the performance of the advisor, without even fundamentally understanding why the performance is doing what it's doing. And if you can understand why your portfolio is performing well as while it's performing poorly during different periods of time, does that not, in fact, give you greater clarity in the decision-making process of helping you accomplish, ultimately, your financial goals? That's what the stress test is designed to do.
Well, you really wrapped that up in a nice little bow there at the end, didn't you?
Thank you. By the way, just real quick, because I'm on my soapbox right now, because I'm a little feisty today, because we haven't done a podcast for a little while. I'm just going to make your job easy today for you, Biggie.
All right.
In a market right now where the S&P has fallen over 10%, where internationally emerging markets have crashed, and by the way, internationally emerging markets have performed so poorly over the course of the last 10 years, it is amazing to see how the decisions are being made by investors. But as we do our analysis, we also do a breakdown of how much is in U.S. and how much is in non-U.S. In that first analysis I did, right, 0.57% of the total portfolio, 0.57, just over 0.5% of the entire portfolio is in international and emerging markets. That's atrocious. And it doesn't matter if you're a long-term investor, it doesn't matter that U.S. has performed better over the short period of time. You leave your portfolio like this, eventually what's going to happen is you are going to end up having underperformance relative to international and emerging markets. And then what do you think the client's going to do? They're going to sell the U.S. and go buy the international and emerging markets after it's already up 30, 40, 50%. Instead of a continuous asset allocation strategy with continuous rebalancing. I've not done one stress test in 2.5 years since we've done this, Matt, where portfolios were actually allocated according to the fiduciary rules of asset allocation between U.S., international, emerging market portfolios. Not one.
So people can go to the website and get a stress test.
Yes.
Can you remind us how they do that, please?
Yes, www.investwithclarity.com.
And I'm sure it goes without saying, if you're getting your prospectus or when you're getting quarterly updates or semi-annual meetings with your advisor, and you notice that you have so many positions and you don't know what they are or why they're in there, take that stress test. So sit down with a professional who really is a money manager and have them explain to you what's going on. Because if you don't understand what you own and why you own it, then you're really not an investor. You're just kind of riding a wave of destruction. Is that fair?
Said.
All right.
Said. I don't even know how you wrapped that up in a bow better than I did.
Well, that is my job, brother. All right. So if you have not subscribed to this podcast, make sure you click that subscribe now button below. That way, every time Mark or anybody at Nepsis comes out with a new podcast, it'll show up directly on your listening device. Make sure you also tune into their radio show. Follow them on social media. There's all sorts of magnificent information that the team at Nepsis puts out on a regular basis to make sure that you too can invest with clarity. So for everybody at Nepsis, this is Matt Halloran, and we'll see you on the other side of the mic very soon.
The content discussed is for informational purposes only. It is not a solicitation or recommendation for any securities that may be mentioned herein. Advisory services offered through Nepsis Inc., an SEC-registered investment advisor.